Well, if you're looking to understand the current economic landscape, implications for the real estate market, or the role of inflation, stay tuned because tonight we are interviewing mortgage broker John Sowerby of Verico TVH Mortgages.
Why is it me? Why am I that guy? I still buy low, you still sell high.
And John, you're not just a mortgage broker with Verico TVH Mortgages. You've also been my business partner and good friend for over 15 years. So Ryan and I would like to welcome you to tonight's episode.
Well, thanks for having me, guys.
Yeah, our pleasure. And Ryan, how are things with you this evening?
Well, I'm excited because we're doing live broadcast, and of course, I'm always referring people to John along the way, and they've had nothing but positive things to say and how easy it is to work with John. So hopefully, you're just as easy to take through the podcast too as it is chatting with you and clients. So
I'll do my best.
It's not John's first time at the rodeo with the podcast. I think he was actually my very first guest when we launched the podcast. But a little bit of housekeeping. So first thing, Ryan, you'd mentioned about the live broadcast. So we actually are streaming this live. It's our first attempt at it. So it is streaming through our YouTube channel, Facebook, as well as LinkedIn. For anyone who is listening through the audience, because we did send out registration forms with a studio audience link, if you have any questions, and this is the reason why we're doing this live, you have an option to send us a question through the chat window. And you can do that through your mobile device or through your tablet. However, if you are listening on your desktop or watching on your desktop, you also have the option to join the stream live to ask your question. So it'll prompt you to put in your name, what your question is, and then you would be logging in or clicking the green button requesting to join us live, and you would be on video like we are now, and you'd have the opportunity to ask your question. So that's a little bit of housekeeping. John, the reason why we wanted to have this episode this evening, specifically live, is because of a recent newsletter that you sent out to our client base. I read all your newsletters, but the subject line caught my attention, where it was 2024 looks better, exclamation. And the reason why it caught my attention is because there's been a lot of doom and gloom with inflation and the economy. Everything that we've been hearing has been more on the negative side. So it's really nice to see, maybe another perspective on things. Maybe we're starting to see the light at the end of the tunnel. So I wanted to bring you in and just kind of highlight points of your newsletter. So I think we're going to start off with understanding the current economic landscape. And John, you had an analysis of the Bank of Canada's interest rate decisions in 2023. So can you maybe provide us with what that analysis was or is?
Sure. So the changes really started after sort of a run of record low interest rates and COVID in the spring, end of winter of 2022. And we had known the Bank of Canada was likely to be increasing rates, but we weren't really sure how much or how quickly. And in fairness, I think the Bank of Canada thought it might have been able to get away with one. I think it might have been able to just sort of make the suggestion that inflation was transitory, and that's a term we heard a lot in those days, i.e. inflation would sort of be here and then be gone. It was just a function of some of the supply chain issues with COVID. And I think they were really hoping that it wouldn't ultimately turn into such a big deal. I think where things took a bit of a left turn was with Russia's invasion of Ukraine, because that really did snarl supply chains to a much more significant degree than I think we'd previously seen, even with everything that happened in COVID. I think what that meant was all of a sudden a real shortage in a number of areas. I don't know how many of us appreciated how much grain, for example, Ukraine brought to the world market before the tanks rolled in the beginning of 2022, but lots of people were much more aware of what impact that might have had on the price of bread and some of the other staple goods in a typical basket. So at that point, I think the Bank of Canada felt that it had probably erred and probably not started soon enough. So what we saw was a rapid acceleration. And through most of 2022, we saw not just interest rate increases, but significant interest rate increases. So typically over the last 2 decades, the average change in interest rates was 0.25%. And at one point, we saw a full 100 basis points. So that's 1 full percent in a single change. That used to be as much as you might see over a year or two. So we really sort of saw them apply the brakes hard in 2022. However, anything that's got some size and momentum typically takes a little while to slow down. So whereas we started to see the first impact perhaps later end of 2022, early part of 2023, we still did see some resilience in the economy. So for example, with the real estate market, we saw a pretty reasonable spring market. And I think that Governor Macklem, the governor of the Bank of Canada, would have preferred that we saw a slightly more sedate market. And so he stepped in again in June, having not raised interest rates since January, with another 0.25 point increase. And then we had one more a little bit later down the pipe. So really, the majority of the increasing was done in 2022, about 425 basis points worth, and then about 75 basis points in this year. The point is, most of those smaller changes were more about psychology and signaling to the market, because frankly, the damage had been done with those significant increases in 2022. But it takes a little while for that to filter through. I think now, as we're on the cusp of 2024, we've seen a lot of that filter through. The economy, if not in recession, and that's a point we should make because today they announced Q3 gross domestic product. So GDP for Q3 was down. Now, in Q2, it was also initially down, but they revised that. And the reason that's important is because 2 consecutive quarters mean recession. That's a technical recession. Because they ended up revising Q2 to a slight negative to a slight positive, it's now only 1 quarter of contraction. But again, the reason that that's important is because as we get to the point where we see more and more negative economic things, we're going to end up in a position where more and more start to go off the rails. So we'll see the economy in general slow. I would suspect every economic number we see for the next several months will largely be negative or have negative connotations. And the reality is you have to hit bottom in a situation like this before you can start to see us move back up to the top. That being said, I do believe we're probably closer to the bottom than we are to the top.
Any expectation from your point of view of any further increases at this stage, or have we peaked and maybe starting to look at some reductions?
Well, one of my critiques of Governor Macklem, and I will sort of add the caveat of he's got a pretty tough job, is that he's maybe been a little quick to say things, and then he says things are going left, and then he ends up going right. If you go back into 2021, rates were going to be low for a good long time, and of course, within 18 months, we'd seen some pretty significant increases. Again, more significant increases in sort of any kind of reasonable memory. So within the last 30 or 40 years. So you've got to take this with a bit of a grain of salt. However, in the last 4 weeks or so, he's made 2 comments that I think are noteworthy. One of them last month, that we're getting to a point where we don't necessarily have to hit our inflationary target of 2% before the Bank of Canada will consider rate cuts. So that's a big one. And then the second part, and again, this was just last week, is, we've probably come to the end of the tightening cycle. And the next move, if there is going to be one anytime soon, is likely to be downward. Now, December 6th, we have our final rate announcement for the year. So perhaps we'll get a surprise, and maybe he will make a change. But I do think at this point he's probably going to leave well enough alone. Um, the GDP number we got today, because of the revision of Q2, isn't enough to sort of push opinion one way or the other. But again, I suspect he'll leave well enough alone, and eventually we will see rate cuts. The consensus among economists seems to be sometime around Q2 next year. So say we're anywhere from 4 to 6 months away from the first bit of relief.
And I guess my question, and we should be careful how we handle this question, the opinions of economists and a lot of the predictions that they make, because I'll be frank with you, I believe it was June of last year or July, I remember a specific day where I had 3 different webinars with 3 different economists from 3 different large financial institutions in the country presenting. And I still remember literally the first one, they had announced that we were in a recession at that point. And I'm thinking, okay, economist says we're in a recession. 2 hours later, I'm in another meeting, another economist, and they said, no, we're not in a recession, but we'll probably be there in the next 3 to 4 weeks. And I'm thinking, okay. And then literally the last one, they said, no, we're not in a recession, probably won't even get into a recession. We might teeter the line a little bit, but it's not going to happen. So where should we be looking for information? Because I feel that that's very confusing for a lot of people.
I would think, in fairness to economists, even they would joke if you got 3 of them in a room, you'd probably get 4 opinions on the direction of the economy.
Right.
I mean, on the one hand, it might be nice if they treated economists a little bit like they treated sports teams and gave them a 1-loss column. So you'd know the guy who called 20 things the right way and 2 things the wrong way is someone you should be paying attention to, but they tend not to do that. That being said, I know personally I have, I don't know if picked and chosen is the right way to describe it, but there are some economists who I tend to pay a little bit more attention to. Mm-hmm. I'm always a little bit leery about taking sort of an end game from their predictions. Mm-hmm. What I think economists are more useful for are their insights, in the sense that, hey, did you notice this in the numbers, or did you notice that? And as an example, I think one of the economic groups that I referred to, Capital Group, juxtaposed the tough talk by Governor Macklem, and he was talking pretty tough up until about a month ago. That included things like, hey, we might need to continue tightening, we might need to see rates go higher, etc., against the report that the governor had actually issued, suggesting that they see considerable potential for slack in the economy next year. And of course, that means that things are going to slow down. So if he's saying we're going to tighten up, but his forecasts suggest that things are going to slow down, those are statements that are at odds with each other. And it's useful for someone to go in and do sort of the due diligence and do sort of the work through on that, because so much is produced. And, this is a real cottage industry, right? So I think any economist would say you have to take what they say with a bit of a grain of salt. Right. But, little things like, gosh, guys, Mr. Macklem is saying left, but, in what he's sort of putting out to the public, it looks like it's saying right. That's noteworthy. And I think that's where economists are particularly useful.
Right. And the situation we're going through right now, does it feel similar to what we went through in 2008? I mean, that's when you and I actually partnered up. It was October of 2008. We launched TVH, and that was scary times, right? So are there some similarities in your opinion?
I really do think there are. I mean, I remember quite plainly going away for Thanksgiving and coming back in October of 2008, and it was like someone had just turned off the tap. The right. Real estate market just ground to a halt, and nothing happened until March break the following year. And then we went on, more or less a 10-year bull run. And if you think about it, I mean, the typical economic cycle is somewhere between 7 and 10 years. So every 10 years, let's say you're going to get one really great year, one really lousy year, and probably 5 to 8 okay years.
Right.
So, this might have been our lousy year. Let's hope.
Right.
And in terms of timing, I think the point to be made is right now there's been a lot of volatility.
Mm-hmm.
And volatility is tough for people because they don't know in which direction things are going to unfold. And that's very scary. And I know, Jim, you and I have talked a little bit before about Mr. Warren Buffett and his thoughts
Yep.
about, be greedy when others are fearful and be
Yeah.
fearful when others are greedy. And
Yep.
of course, it's easy to say, hey, it's a great buying time when things are falling apart.
Yep.
But it's not so easy to write the check for that, $1 million home. So, I can certainly appreciate why people step back. The trouble is the chaos of the market is often what creates the opportunity.
Yeah.
So going back to 08, 09 and looking at sort of the similarities, one is a very similar sort of grind to a halt this year as there was in 08. I don't think anything fundamentally has changed. So I will go back to something I talk about a lot in my newsletters, which is supply and demand. We're all aware from the news there is a chronic undersupply of housing, and the demand continues to remain quite strong. So like in 08, if anything, it's more significant now in 2023. So, from that perspective, what I think we're in is a bit of a quiet time, but I don't think it will last. And I think what we'll probably see is we'll see the first sort of solid signs of the price of money coming down. So for example, in the last week, we've started to see the bond market come down a little bit. And when the
Mm-hmm.
yields come down, fixed rates start to come down.
Right.
And eventually, as fixed rates come down, the variable rates will start to come down. There's a correlation. It's not 100%. So it doesn't mean if fixed rates went down a little bit today that variable rates have to go down.
Right.
But on average, they tend to move more or less together. So directionally, they'll go in the same way. So right now, we're starting to see things abate a little bit. The market is starting to take in what Mr. Macklem is saying, which is, hey, the worst is probably over. And they're starting to sort of gradually align themselves in the other direction. And then what's probably going to happen is we're probably going to end up in a position where, like I said, 5 or 6 months from now, we see that first rate cut,
Mm-hmm.
and then everyone's going to jump back into the pool. The trouble with that, of course, is you may have potentially missed the opportunity. I know we're going to go there and talk a little bit about what
Yeah.
those things mean, but the volatility piece that we're seeing right now, that's why people are standing on the sideline. It's not because all of a sudden all of the people who live in Canada have decided they don't want that home. They don't want that house. It's because they're concerned right now about the implications of taking that step.
Right. Now, has pricing changed on variable rate mortgages? And what I mean by that, prior to the correction in 2008, banks were offering prime minus. And then once things came to a grinding halt, it was prime plus. And then over time, pricing readjusted again. So have you seen, as a mortgage broker, pricing adjustment on variable rate mortgages?
In some respects, 08, 09 was worse than it is today. And that's because the nature of the difficulty in 08, 09 was around credit specifically, and the potential collapse of the credit market. And I have a background with managed money, mutual funds, pensions, et cetera, and still keep in touch with some of that crew from back in the day. And I knew some of them were absolutely petrified of what they thought could have happened, i.e.
Right.
with the collapse of sort of the global credit facilities available. It doesn't seem that bad. However, we have seen some tightening on the money market side, and money market is typically where variable rates priced.
Right.
So for example, 18 months ago, we might have had prime minus 100 basis points or a full percent. Today,
Yeah.
maybe it's prime minus a quarter,
Okay.
so 25 basis points. So it's a
Yeah.
fairly significant difference.
Mhm.
There are a variety of reasons for that, but suffice it to say that will probably change over time. We'll probably see that improve a little bit, would be my guess, but it really is hard to know until we sort of get there. And we're not at a point where we're through the volatility yet. So I think the market is still trying to find some direction.
Right. And I know many people have different opinions between, 5-year fixed or get variable. And um, right now, the haters of variable are pointing their finger saying, see, we were right. You should, always be in a 5-year fixed. What is your opinion on either one? And what are you recommending today to a lot of the clients who are looking to refinance or purchase a property?
We did a lot of 3-year fixed terms in 2023 because it seemed to be a fair middle ground. The yield curve, which is typically denoted as sort of a shorter term to longer term up and to the right, so a bit of a curve, usually because shorter term rates are lower and longer term rates are higher. But the yield curve was actually inverted. So what we saw were short term rates were higher, longer term rates were lower. That's usually an indication of a handful of things. Again, that's where economists are great because they can give you an understanding of sort of what historically an inverted yield curves mean. Oftentimes it's associated with a recession, et cetera. But
Right,
what it also tends to mean is there's a feeling that rates will go down.
right,
And so the trouble is that 1 and 2 year term was just a little bit too high and probably a little bit too short a term back in January, February, March to get us through the volatility.
right,
5 year though seemed awfully long. And I've seen people take the 5 year, and my concern with that is taking sort of the longer terms as a result of a shorter period of volatility is often something people will have cause to regret. So those seemed high, maybe not now, but maybe at the time, a year from now or 18 months from now. So that 3 years seemed like a good saw off. And we were seeing rates sort of when Silicon Valley Bank collapsed, we saw rates sort of in the middle high fours. So that was reasonable. Um, 3 year terms got as high as the middle high sixes, call it within 6 months. Variable rates hadn't seen much movement. So as those two converged, and you started to see 3 year terms get closer to where the variable rates were, then the shift started. And probably in the last 8 weeks or so, we've started to take a good hard look at variable rates again,
okay,
because variables will probably see some downward movement as we get into the new year.
okay,
And the reality is you have more flexibility with a variable than you do with a fixed.
right,
So you have the right to convert from a variable rate to a fixed rate at a time of your choosing. And generally there's no cost, and generally there's no need to be reapproved. So you don't have to go through the process again. If you were to go from a fixed rate to a variable rate, let's say, you would need to go through the process. There would likely be costs incurred. You would see a penalty. You would probably have to involve a lawyer. So it's a little bit of a different story.
And at TVH, we always tell our clients we prefer strategies that provide you flexibility because we
Yeah.
really just don't know what's coming down the pipeline, right?
Well,
So you
think
want to have
about
that flexibility.
exactly. Well, think about how much changed for people during COVID, and then since COVID is more or less ended.
Yeah,
Um, and I would say, besides price, flexibility is probably the most important component in building out your financing. But the reality is, everyone is aware of price because price is easy. No
yeah,
one's ever needed me to tell them that 3% was better than 4%. But what do things look like in 3 years? What's your exit strategy? What does it look like if you have to make a change? What does it look like if you have a hiccup with income or life in general?
yeah.
That's where I think typically I will tend to add some value, and variable rates almost invariably are better choices in those kind of situations.
Ryan, I know you're chomping at the bit there, so maybe you can lead us into the real estate market and some of the implications.
Well, I just want to comment one thing that, when going through the process with you, John, and the difference that I've seen in other institutions is you ask a lot of great questions that get people to really think about how flexible do I need to be in 2 years or 3 years or 5 years, things that often don't come up with most institutions. And I know I've had a number of clients come back to me and say, there's a lot that I took away from talking with John that I never even thought about before. And when they've approached another institution, they were never asked those things. It was just very transactional. And it was just like, let's just get the transaction done. Let's lock you in at a rate. And that is it. But again, I just wanted to call out what a great experience it has been with the clients that I refer to you, and that you're asking these questions that are very important for them and their families, to think more longer term and be flexible, whether they want to move into a new home in the next couple of years, or if they want to do a renovation on their house. So, with that being said, yeah, the real estate market obviously is always a hot topic for a lot of people. What are some of the implications that you see going into the next year? Especially, we're looking at buyers and sellers, and I think based on your article too, we kind of started off with a relatively balanced, but now it seems to be swaying to another direction.
Well, again, if we go back to 08, 09, that was a situation where we saw things swing in favor of the buyer. And then really almost all seller after that for a decade. I think in 2017, as a result of some changes that the provincial government at the time made, there was a bit of a slowdown. We've had very little sluggishness in the market. Otherwise, it's generally been brisk. We've seen a lot of records set, etc. So what I try to do is take a step back and say, okay, is there something fundamentally different? And by that, I mean looking at sort of the building blocks of the housing market. Is there something that I think has changed, that has materially shifted the way people do housing? And I mean, a good example on the commercial side is with the migration of workers out of the office during COVID, look at all of the commercial space that's now empty. I think Jim and you were talking about it the other day, almost 20% in Toronto is currently vacant. That's pretty significant. However, if we look at residential, we continue to let a lot of new Canadians into the country. The thing about Canada is it gets cold, so most of those people want a place that's indoors to live. Get that? We are not building at the level we need to. I think in point of fact, CMHC released a report early in the year that suggested we needed to build another 3.5 million homes by 2030. So that was less than 7 years at the time. Now we're 6 years away. We are not building anywhere near that pace. And this always brings me back to the first day of Economics 101 and supply and demand. You can't get away from it. If you have an undersupply and the demand stays strong, then price becomes the lever that you see go up and down. And in this instance, the price pressure is almost certainly going to be up. Now, again, are there going to be periods of 3 months or 6 months, a few quarters, whatever, where it's a little bit stagnant, etc.? Very possibly. But people will find ways around more expensive money. Whether it's a couple of siblings and their families will buy a house together and one will live in the upstairs and one will live in the downstairs. I mean, these are not new concepts. There were certainly lots of people who came, to places like the United States or Canada in generations gone by where you had multiple generations of a family living in the same home. This is a way around that because people do want a piece of earth that belongs to them. They do want a place that they can call not just a house, but a home. So people will figure that out. But the trouble is the cost just continues to go up. People see less and less sort of return for their dollar. And ultimately that's not a positive. So, in terms of what I think we've got a bit of a window if you're a buyer. We've seen a reasonable level of listings. We haven't really seen panic selling. I think we've seen the stat I released in my newsletter, and I always take these stats with a grain of salt because I try to find, something from Stats Can, et cetera, and everyone seems to have a different number. But they had suggested that in Canada from September 2022 to September 2023, we had seen a 1.2% increase in the price of houses. Now, the peak of the market was probably April 2022. So it's entirely reasonable to think that from April to September 2023, we'd seen a decrease. But by the same token, given the kind of run we had in 2021, if you went back to 2021 in April and you went to September 2023, the price of houses is still probably up. So you see the difficulty in trying to sort of really nail it down, because it mostly depends on your point of view and the time frame you're looking at. But here's what I'll say. The price of money, so your interest rate, that will fluctuate. That will typically go up, and then it will go down, and then it will go up, and then it will go down. The price of housing typically in most major metropolitan areas of Toronto, Vancouver, Montreal, places like Calgary, etc., tends to go up. So if you can find a point in time where it's either come down slightly or at least sort of holding steady, to me, that typically represents, in our current restricted supply situation, an opportunity to buy. The scary part again for people is pricing of the money is high. But my expectation is a couple of years from now, that price of money will probably be half what it is today, but the value of that home will probably move higher. And the reality is, the first time we see that interest rate cut, or the first time we feel that interest rate cut is coming, the market will shift and we'll probably get back on the train we were on. And I'm not saying that's a good thing, and I'm not saying that's a healthy thing, because in the long run, there are issues with one-rate pricing. But until they fix the supply issue, that is likely what we're going to continue to see.
I think it's fair to say too, I mean, I think the last, I guess, since COVID, a lot of abnormal swings either way, where prior to that, I guess we would expect more consistency in terms of some growth. Like, yeah, we were definitely in a hot market, and a big thing is supply and demand, and I don't think that's going to change anytime soon, especially with immigration, and we need immigration, and we don't have a place for people to live. But I think it's fair to say that the last 3 years has been very abnormal with the market. Even the predictions, again, when COVID came out, and I believe a lot of the experts were predicting that real estate values would drop by 35%. And I think the opposite happened, right?
Again, hard to know. And I mean, if something like a pandemic is, hopefully, touch wood, a once in a century kind of thing,
Yeah.
Hard to know how anything or everything is going to happen all at once. That being said, I think the last number I saw, and I'm a fan of my stats, the last number I saw suggested over a roughly 40 or 50 year timeline, the typical growth for real estate in Canada was around 5.5%.
Right.
I suspect if we put sort of a 5-year lens on what's happened, including the massive spike in 2021, the big pullback in 2022, the kind of tepid in between market that's been 2023, I suspect you might sort of be more or less within that average. Right. Again, the killer is not so much the longer term average. Like, if someone came to me and said, "Hey, John, what do you think about real estate?" Well, in 20 years, it's going to be more expensive. But if they said, "What do you think about it next month?" That's a great question. And ask me in a month, because I just couldn't tell you.
Right. Now, the federal government recently made some announcements in their fiscal update. So Ottawa loosens mortgage stress test in housing-focused fall fiscal update. Can you maybe explain the impact of what they announced, and if there's going to be any major significant impact? I mean, it sounds like fantastic news, but kind of share your perspective on the announcement.
And I don't mean to sap anyone's enthusiasm about any potential good news given the year we've had. I don't want to be that guy. Yeah. But the reality is, while there was a fair bit of pomp and circumstance around the announcement, there's probably not an awful lot there. There were a couple of things that they clarified, which I think will be useful. So, for example, if you're moving your mortgage from one institution to another, you don't necessarily have to qualify using the stress test, which is absolutely a help in certain instances. But the reality is those kind of mortgage transactions are few and far between. Most people, when they come to the end of their term, they are looking at some sort of a refinance, i.e. accessing equity. In that instance, the stress test absolutely does apply. They have... I don't know if it's so much introducing new rules, more along the lines of maybe trying to push folks on some of the rules that they should be observing, but things like making sure that you notify people in advance of their pending mortgage. A lot of larger institutions will wait until the very end of the term, so they don't give people much time to try and shop around the market, because of course they recognize, people get busy. So,
The
better to
banks
go to
do
them.
that?
I know, it's shocking, isn't it?
Wow.
But better to go to someone a couple of weeks before renewal when they're, up to their eyeballs with, holiday plans, or the kids are doing this, or, I've got to take care of my parents and, get someone out to an oncology, review. It's just the way things have gone. They're saying now you've got to be a little bit more ahead of the curve on that, which is a positive. Again, I don't think there's anything that I would look at in the announcement and say, well, that's absolutely terrible. I think what I'm saying is there's not much in the announcement that I look at and say, well, that's the silver bullet. And I think, in fairness to the federal government, I don't think they suggested it was the silver bullet per se, but I think they're probably making a little bit more ado of it than I would.
Right. And how do you see things playing out? Like right now, John, I've got clients that I'm working with who are literally taking cash advances on credit cards to make mortgage payments because they didn't anticipate their mortgage payment going up by $1,000, $1,500. Are the banks right now, mortgage lenders, are they tightening up their lending? And will it be, in your opinion, more difficult for people to qualify when these renewals do take place, considering that many people are increasing their revolving credit because they have no choice?
So the best way I think to describe it, and it's not dissimilar to many in industry, is we work on a kind of a pendulum. So what happens is we'll see the industry swing one way, and then gradually that momentum will peter out and it'll start to swing back the other. For the last several years, we've had an incredibly hot market. So the general bias, whether it's from OSFI, the Office of the Superintendent of Financial Institutions, or name your regulator, has been to tighten lending and make the access to cash a little bit more restricted. And all well and good in a hot market. We're now in a position where 10 increases in interest rates over a roughly 18-month time frame has fixed a lot of that, organically, if you will. However, the various regulators and government bodies, and again, God bless them, have continued along with their tightening ways. So it's I guess what you might refer to as a bit of a perfect storm. We are seeing that start to loosen up a little bit, and I think that's necessary, because you can't squeeze, like, once the toothpaste's out of the bottle, you can only squeeze so much more. So again, the killer is always the in-between, while we're waiting for the momentum to sort of build in the other direction. Now, there are ways that you can address it. So one of the positives for a lot of people who've been in a property for a few years is, even with the ups and downs of the last 18, 24 months, they have seen some substantive equity accrue. So if they bought back in 2018 or 2019, they've built up some decent equity. The option of looking to extend their amortization is something that's there. And I can appreciate not everyone gets excited about the idea of, taking their debt and essentially putting it on the book for a longer time. But cash flow is a big component. So I can also appreciate people wanting to pay down their mortgages more aggressively. But if you're paying down a 5 or 6% mortgage by cash advancing on a 22% credit card so that you can pay it off in 20 years, you're doing something wrong.
Right.
So in that instance, maybe you go back to a 25-year amortization. Maybe you go to a 30-year amortization. You take some of the bite out of that monthly impact. And then when things improve, and I think that's another general issue that I've seen, because one thing I will say as sort of an aside about COVID, I saw industries that were real winners, where I had clients who were making 20, 30, 50% more than they were a year or two before. And I saw some industries where, unfortunately, they were real losers, and the impact had been significant on their bottom line. Right. So being able to, again, spread things out, I think, is a smart option. And then when you see things improve, most lenders that are reasonable are going to provide some decent prepayment options. So you can always attack the mortgage a little bit more aggressively when times are good. And obviously that's part of the discipline of financial planning. So I know that's the sort of thing that you and Ryan will talk to your clients about.
Yeah, and one other thing, I mean, Ryan and I recently launched TVH Cash Flow Solutions, and that's our behavioral cash flow planning company that we help clients just focus on cash flow, not just budgeting. It goes beyond that. And one of the things that we see in working with some of the clients is many people are kind of sitting on the sidelines. They don't want to necessarily refinance their mortgage because they're hearing 7% or 6% or whatever the rate is. We're looking at their overall debt because we're not just focusing on the mortgage debt. We're looking at the overall revolving debt that they have at the, lines of credits were once, 4 and 5. Now they're paying 12, credit cards at 22 to 25 and 30. And these debts are increasing. It's killing their cash flow because because of the payments that they have to make. And when we walk them through the process, sometimes it actually is better to do a refinance because if you look at the overall interest cost between all the debt and we consolidate it and free up some cash flow, it puts a client in a much better financial position. And again, it loosens up the noose a little bit because of freeing up that cash flow. So in your opinion, should people be sitting on the sidelines if they are carrying 30, 50, 60, $80,000 of revolving, credit, or should they at least have a conversation with you to say, or even with Ryan and I to go through a cash flow plan to say, hey, maybe this might be an opportunity for us to consolidate and refinance. And sorry, we don't use the word consolidate anymore. We use unifying. So we unify the debt now.
I did not know that. Good to know.
Yeah. So what's your opinion on that?
I have this conversation a lot with people, and the simple reality is I will often get pushback from people who say, you know what, I've got this 30, 40, $50,000 in credit card debt. I'm going to clear it. I'd like to keep the mortgage as is.
Right.
And psychologically, I understand that. I think I would just make it really simple for people. It's almost certainly not going to happen. They're almost certainly not going to pay off that debt by just making monthly payments. There might be a select few who can do it, but my experience is they are very few and very far between. It is, as best I can give you a bit of an analogy, it's like pruning a tree to make it grow. Sometimes you got to cut back a little bit, and then hopefully you get greener shoots and better growth. That's what we're talking about here. You're taking a step back with your mortgage, but it's to try and rationalize everything else. And case in point, in just the last 24 hours, I've had 2 conversations with 2 different couples. Both had started in a small starter property, kept it, moved into another place as their family grew, rented, ended up in a situation where things were going pretty nicely, but coming to the end of their term saying, hey, we're going to have some much larger payments. Well, as the family grew, they took on some additional debts, minivan, whatever. So what we did was we went through the overall debt load, figured that by adjusting some amortizations, pulling a little bit of capital to help pay off some of the higher cost payments, and again, trying to consolidate in a way that was sensible, as well as having some tax considerations as well. We were in a position where we were able to keep their overall cash requirements pretty close to what they had been previously. Whereas if we had sort of gone status quo and just turned over a straight renewal, they probably would have seen cash flow requirements increasing by anywhere from 50 to 60%. And that would have made it untenable for them. So in this instance, they'll weather the storm. They have both said that, they're not necessarily looking to be landlords forever, but they still have enough energy to be landlords now. And in the long term, given it's not necessarily a seller's market, waiting to dispose of those assets at a point when they get bigger bang for their buck made sense to them. So we went through the process, put the numbers together, and ultimately we were able to keep them relatively close to where they were.
That's great. I'm just going to pause here for a second and remind people that if they do have a question that they want to ask John, Ryan, or myself, if you are part of the audience, go ahead and ask the question through the chat. And if you want to be on video, you also have the option to request to call in, and we'd be more than happy to take your questions. Ryan, is there anything you want to ask John at this point?
Well, again, John does a lot of great work when it comes to working with clients, and for us to, understanding people's cash flow is really important, and making them aware of where they're currently at. And again, I just again promoting John as far as his ability to ask the right questions and make sure people understand that what are the different types of debt that they are currently holding on to, understanding the different rates and how that can really impact them. And then for us to just to understand, what is the behavior that somebody has with their debt. And, we have a very simple quiz that people can take to understand their mindset revolving. I always say sometimes it's almost like the love languages of finance, and understanding your partner's way of understanding money and how each of you can cohabit one area and understand each other's spending and how they think of money. And John does a really great job of doing that with clients, because there's a very old school way of, I need to pay off my mortgage, I need to pay off my mortgage, and not thinking about the bigger picture and how these 18 to 25% interest rates on your credit cards can really get you behind the ball, and how quickly it can kind of snowball over time. So, yeah, I don't have any immediate questions right now, and I'm looking over the chat too. I don't see anything. Some great comments too. John's a magician from one of our clients. So yeah.
Yeah. Well, then to bring it back to the original subject line of your e-newsletter, John, clouds are lifting 2024. Things are looking a little sunnier, perhaps.
Yeah, I think that again, we go with the economic cycle, and if you figure you've got that one good year and that one bad year, and then half a dozen so years, I think 2023 was probably the not so great year. And that suggests mathematically that next year should be either a good year or an okay year, but certainly better than a not great year. So I'm just playing the numbers, but I'm a numbers guy, so that's what you're going to get.
Right. That's great. So I think we're approaching end of time here. We like to usually stop at the 45-minute-ish mark, and we're a little bit over that. So I think a couple of things. First, I'd like to maybe kind of promote the cash flow planning program that Ryan and I are helping our clients with at this point. So again, we're not really fans of budgeting. Budgets don't typically work for most people. It's all about behavior. And, we're finding that people who are, creeping in and adding their revolving debt, it just keeps going up and up. As per John's point, chances are, if this has gotten to a certain point, you're not going to pay it off. It does have a bit of a snowball effect. We find in working with some of those clients, it seems to be more of a pattern as opposed to a situational event, right? So I encourage people to reach out to Ryan and I if you're interested in going through the behavioral cash flow process. But more importantly, if you're sitting on a mortgage, there's a renewal that's happening, or you're sitting on some debt, some revolving debt, you just don't know what to do. I discourage you from going to the bank, and I encourage you to go to John, because as Ryan has mentioned, and John, I say this, we started off as business partners. We've become really good friends throughout the years. But what I will say is the thing that really attracted me to working with you and partnering up with you is, something that Ryan has already mentioned. It's not just about the transaction. It's not just about getting that mortgage through the door. You ask real legitimate questions. What are your plans 3 years from now? What are your plans 5 years from now? We want to make sure we don't just get you the best rate necessarily. We want to make sure we put you in the right mortgage. I think people who don't do that and things change regret it. So, definitely I encourage people to reach out to John. So there's a couple of ways to do that. First, you can go to our website, tvhgroup.ca. You'll see the picture of the four partners. John is there. So if you want to find out more about John, you can click his picture. It'll take you to Verico TVH Mortgages page, and there's contact information there. But John, how else can people reach out to you if they have any questions? No obligation. They have some questions. They want to talk to a professional. How do they get a hold of you?
They can give me a call. My number is 416-488-0074. That's 416-488-0074. And if you don't get me, you'll get one of my team during the day. If you call off hours, just wait a little bit. It will go to voicemail. And then for those who don't like to pick up the phone, and I know there are lots of people who don't like to pick up the phone, an email is just dandy. So that's JON. So just like it shows in my box there, JON, no H, at tvhgroup.ca. So John at tvhgroup.ca. And of course, Ryan, Jim, our partner Sonia on the legal side, our partner David on the chartered accountancy side, they would all be happy to refer to me and I to them as well.
That's great. Ryan, any final thoughts to add? Any comments?
Actually, one question that just came up in my head too is, as I've seen a lot of articles saying that 2024 is a big year for a lot of expiring mortgages. What is the 3 months, 6 months? The banks are only giving people 2 weeks, 4 weeks to renew. But when people are looking at those renewals, when is a good time to really start reaching out and shop?
I usually encourage people to reach out about 6 months in advance.
Okay.
We can generally start to lock things in about 4 months out.
Yeah.
But the reason I encourage them to reach out so much in advance is because sometimes we may need to do a little bit of work, especially under the current environment, which is a little bit tighter still, to make sure that they're as presentable as they can be for the lender, because lenders are a little bit more difficult in our current environment. So we want to make sure that we smooth the edges to make the ultimate approval as simple as we can.
Okay. Thank you.
Wonderful. Well, John, we thank you very much for joining us in today's episode. I think live went smoothly, or as smooth as can be expected. So we might have to do some more live events in the future. So John, once again, thank you very much. Ryan, thank you. And until next time, everyone have a wonderful evening. Take care.
Why is it me? Why am I God?